Okay, welcome back. Again, today we're having our next second session of Money Made Simple. Um, we have with us Anthea Perkinson. She's our panelist today. I just want to do a quick overview about um about the come on about the census. And I know most of you know this year is the year for us to do the census. And PSS has received a grant um, to help ensure a complete and accurate census is taken for the community where we serve. The census is very important because it impacts funding decisions for things like infrastructure, healthcare, education, and more for the next 10 years. For the first time, people will be able to respond to their census in three ways: online, by phone, and by mail. If you reply by the end of April, it's like 3 more days or 2 more days, no one from the census will come to your residence to obtain your response. Census takers will be sent to residents that have not responded starting mid-May through July 2020. Count everybody in your house. That includes babies, young children, foster children, and no relative will live with you. You can complete the census at 2020census.gov. Um, thank you. And without further ado, you can start.
Great. Okay, so here we are. Today we'll be talking about understanding credit and managing debt before and after retirement. I'll make some comments relative to our current situation, being shut in with the pandemic, and how we should think about our finances given that current reality. PSS, Shana did a brief introduction, founded in 1962, strengthens the capacity of older New Yorkers. Life University, we're part of Life University, Money Made Simple, provides educational programs, 10 senior centers, and currently online. Free personalized support for those caring for someone who's frail or chronically ill, families where a grandparent is raising a grandchild. And they also have a coming of age program to inspire people ages 50 plus to live with passion and purpose. 10 centers helping older adults stay healthy and engaged. And a lot, like myself, are volunteers. So today we're going to talk about why retirees should think about credit, how to manage credit, the difference between credit reports and credit scores. Those are distinct things. Debt and how to manage your way out of debt. Then, of course, I'm going to offer some practical tips and resources. The appendix on identity theft is not something we will formally review unless I get through this in the space of an hour. I am happy to send this presentation to Shana for distribution with a thank you email so that you all have a copy of it after today's event. So why should retirees or anyone really think about credit? Because it allows us to acquire goods and services without paying for them first. A great example of that is the ability to use a credit card, and whether you're walking into a supermarket and buying groceries or you're ordering things online, it allows you to acquire these goods without actually giving cash. So it's a very convenient way to pay for purchases. It also allows individuals to finance large ticket items. So for example, getting a car loan or leasing a car is an example of using credit, your good credit, to acquire this asset, be able to drive it around without paying for the thing in full. It also allows individuals, and this is particularly important for retirees, many of whom think they shouldn't have credit cards once they stop working. But it allows individuals who are retired and even before retirement to manage the financial impact of a sudden illness, injury, or other type of emergency. So where might this be impactful? Well, I have worked with individuals who took money out of a 401k or IRA account to pay off a medical bill. an unexpected injury or illness, ran up big hospital bills, took money out of the retirement account to pay for this. And there are two challenges with that. First challenge, when you take money out of a retirement account, you have to pay taxes on it. And so it's just that much more expensive in terms of paying off those bills. The other challenge is that once you take that money out of that account, it's no longer invested and available to grow and compound for future expenses. In many instances, you're far better served using credit, whether putting an unexpected bill onto a payment plan or a medical credit card or a regular credit card, or divvying it up among the three might be a better way to navigate your way out of one of these sudden unexpected expenses. So managing credit, let's talk first about the difference between a credit report and a credit score. A credit report, and we all have one if we use any form of credit, it is simply a detailed history of all of our uses of loans and cards and our repayment, whether we paid it on time in full or whether we missed a payment here, sent it in late here. And this captures our use of credit cards, store cards, bank loans, student loans, mortgages, etc. If we've made late payments, that'll be on there. If we've defaulted, if we've been taken to court for non-payment, that will be on your credit report as well. A credit score can be thought of as a grade between 300 and 850 for the information that's on a credit report. Now, the crazy thing is, credit reports are produced by one set of companies. Credit scores are often produced by other companies. Some credit bureaus, credit agencies like TransUnion will offer its own type of scores, but for the most part, the traditional ones like FICO, it's a completely separate entity from the people who put together credit reports. Typically, the numbers run from 300 to 850, summarizing the activity included on the credit report. And the reason this came about, the first company to invent the credit report, or credit score rather, was Fair Isaac Corporation. When we had computers that could do regression analysis, they determined that if you could score the data on a credit report, you could predict whether people would repay their mortgages. That was the first important use of FICO scores. So because it's used to predict behavior, it is also therefore used to price the cost of credit, meaning the interest rates charged. If you have good credit, you get inexpensive credit, meaning your interest rates are lower. If you have a poor credit score, a history of non-payment or trouble keeping up with bills, you're going to pay higher interest. The specific types of information that's collected, when you look at your credit report, there'll be identifying information. So your personal identifying information, including your date of birth. Printed, you'll see only the last 4 digits of your Social Security number. Some of the credit reports include your full employment history, home ownership. All of them will include addresses for your past 10 years. And then account by account, it'll include your payment history for every type of credit account. How much credit you have, what your credit limits are, and whether or not you've made any late payments. Inquiries. So if you apply for a credit card or a loan, you will see an inquiry against your credit report, and that will be on your credit report for a year. Employers, and I'll stop here and say, since late 2017, in New York State, employers are no longer allowed to run your credit prior to making you a job offer. There are certain carve-outs. If you apply to a bank or to the police force for a job, they have the right to run your credit. But every other company is not allowed to do this anymore. Outside of New York, employer inquiries as part of hiring will be on your report for 2 years. It also includes public records, including bankruptcies, foreclosures, and judgments. So who are these three companies and what are they doing collecting all this information? Well, they are Experian, TransUnion, and Equifax. And probably the best known to us right now is Equifax, because you'll probably remember that a few years ago they had an enormous data breach and a lot of people had their credit report information and personal identifying information compromised. And as a consequence, we all get free copies of our reports and we have the opportunity to freeze our credit reports for free as a result of that data breach. So the basic business of these companies is to aggregate information on how each one of us uses credit, how we take our Target credit card and shop at Target and maybe other stores, how we pay our Visa bills, whether or not we pay our student loans, whether we're on time with our mortgage payments. So they aggregate all of this electronically and then sell it to issuers of credit. Banks that want to issue credit cards would like you to sign up. Mortgage lenders, if you go in to apply for a mortgage loan, they have access because they pay for subscription to view people's credit report, and they look at it to make sure as part of their underwriting that you're a good risk for a 30-year or other type of mortgage. Credit card companies that may be coming out with a new type of card and want to sell this, promote this card to particular people, they buy the right to mail these offers to individuals who have a credit profile with certain characteristics. So for example, if you've ever noticed that you receive very targeted direct mail solicitations, whether for credit cards or things like cruises or timeshares or vacation clubs, the company that is marketing that probably bought an address file from one of these three credit bureaus to make that offer to you. These companies also respond to credit background checks for employment, for loans, etc. So that's the business. Now, knowing that so much personal and sensitive information is being stored and managed by these companies, since 2003, there has been a fair and accurate credit transaction law on the books. So under federal law, we're each entitled to get a free credit report from each of the three bureaus every year, so every 12 months. Additionally, we're entitled to another free report if we've ever been denied a loan, a job, or insurance based on what's on the credit report, or for unemployed, or if a report is inaccurate due to fraud, including identity theft. So very important that we look at it periodically to make sure that the information there is right. I will tell you that there is an awful lot of erroneous information on many credit reports, information that should have fallen off, information that doesn't belong to you or to me. So it is well worth taking a look to make sure that it is absolutely accurate. So where do you order a credit report? There's only one place where it is free. And you'll see up at the top on the left, annualcreditreport.com. This was the website mandated by that 2003 law, the Fair and Accurate Transaction Law, that anyone who goes to this website can get to each of the three credit bureaus and request a free copy of their credit report. Now I have, excuse me, the instruction to type this into your browser. Never, ever, ever Google that website, because there are imposter sites that are trying to steal your personal information. So you go on what you think is annualcreditreport.com and it'll look close, and it'll start asking you to identify you by entering your date of birth and your address and your social security number. And then up will pop a request to input your credit card information. That's a fraud. This is a company, an imposter site trying to sell you some bogus credit monitoring service that you don't need. And so you have to make sure that you get to the right website. When you get there, it's going to say welcome and how important it is to check your credit report periodically. And it's going to walk you through very simple steps to select one of the 3 credit bureaus. It makes sense to order only one at a time. Make sure that it is accurate, and then you can, down in a couple of months later, order the next one and check it, so that if you have to make corrections, you can make sure that that information is properly shared, one agency to the next. By law, they all have to have the same information, and there is some coordination. Sometimes there's a delay between what Experian reports versus Equifax, etc. If you prefer to call, the number is here. You're going to be asked for your name, address, date of birth, and social security number. They have to make sure that you're you before they will send you your credit report. Now, to get an estimate of your credit score, and this is almost dated information, you can go on creditkarma.com. You don't have to set up an account. You don't have to buy anything. It's an approximation. But what I will tell you is that over the past couple of years, a lot of the big banks have gotten into the business of offering FICO scores as a customer benefit. So Bank of New York does this, Chase does this, HSBC does this. It's almost standard operating procedure. So there really isn't a lot of reason to go to Credit Karma, although it's an interesting website and they've got a lot of interesting ideas for how to improve your credit score. Now, when you get to, I guess I'm going to go back one second. When you go to annualcreditreport.com and you click on which credit bureau you'd like to check first, and I always recommend Equifax, simply because it's the easiest to read and understand. They're all laid out just a little bit differently, but Equifax does a very good job of explaining all of their abbreviations and making it somewhat intuitive. So you get to Equifax. So from annualcreditreport.com, you click on Equifax, you are hyperlinked to the Equifax website. Now you're going to be given a little test to make sure that you are you and not an identity thief. So after you enter your name, you're going to be asked to answer some questions about current or former credit accounts. And this is a little tricky. You have to pay attention because you should recognize if the question is really you or not. So for example, they may ask, what is your credit limit on your Visa card? And that will be an answer you know. Then they may ask, what is the monthly amount on your car lease? Well, if you don't have a car or a car lease, you're going to answer does not apply. The idea is that if you are an identity thief, you would just kind of guess and try to get in, and this would stop you. If you go through these questions and you answer them correctly, 2 things should happen. First, you get access to your credit report, you see it, you have an opportunity to download it and print it. If you get through these questions and there's a problem, either you've answered something incorrectly or they're not convinced that it's you, you're going to be given a message that you need to mail in a form to get a copy of your credit report. That's not necessarily a sign that you've been a victim of identity theft. It just means that there is conflicting information on your file. So you do need to get a copy of it in paper form to look at it. Now, if you are somebody who doesn't regularly use credit cards, maybe never had a mortgage, never maybe took out a loan, you have what's called a thin credit report. And there's not much on there beyond very basic biographical information, where you live, last digits of your social security number. So you too may be told to send in the form, and you will get back a very thin piece of paper with not a lot of information on it. And it's simply because if you don't use credit, there isn't much to report. Okay, so what to look at on your credit report? Number 1, you want to look at all the open and active lines of credit. So do you recognize all of the credit cards that are listed and the information that's reflected? Are the balances approximately right? Are your credit limits accurate? Are your total monthly payments and minimum payments reflected properly on the report? It'll also indicate the mix of credits. So if in addition to credit cards, you also have maybe a personal loan or maybe a mortgage, that should be listed as well. Any delinquencies, if you've missed a payment, forgot to mail it in, if you've ignored a debt, forgot about it, it got charged off, maybe it went into collection, that will be reflected on your report as well. Same thing with judgments if that creditor ultimately took you to court. Items on your credit report: inquiries shared with others, meaning you applied for a credit card or a mortgage or some other loan and they checked your credit. That will be listed in the back. Employers, same thing, except that no longer happens in New York State, other than the police department and certain bank jobs. They are going to stay on your report for 2 years. Inquiries shared only with you. So you go into annualcreditreport.com, you get your Equifax credit report. This has no impact on your credit score, and it's not even listed on your credit report. So who uses your credit scores? Or why should we be concerned about how good they are? Your prospective landlord. If you're going to go sign a new lease, very often they're going to run your credit, make sure that they have a good likelihood of being paid their rent. Your cell phone company. If you've ever wondered why when you walk into the Verizon store, they ask your social security number, seems a little abrupt, but they do. And it's because they are doing a short form credit check. And if it comes back that you've got good credit, you get the cheap plan. If you have poor credit, you get either the more expensive plan or need to put down a deposit. Cable and gas, electrical utility, they do a check as well to determine whether you need to put down a deposit. So this can come up if you ever move, particularly if you move state to state. They want to know that you're going to be responsible about your bills. Obviously, your car loan company, or if you buy a car, they're going to check your credit report. And your insurance company, which a lot of people don't know about. Your car insurance premium is as much determined by your credit score as your driving record, which seems a little bit crazy. And why is it that if you have a good credit score, you get less expensive car insurance? Well, again, remember my description of how credit scores got started with all of this regression analysis, these people putting together predictive computer models. One of the things that they have done regression analysis to determine is that people with lower credit scores are more likely to make a claim for insurance purposes. And so the way that they manage this is if you have a lower score and are therefore considered more of a risk for an insurance claim, they raise your premium. Because remember, the insurance company's business is to take all of our premiums that we pay every month and hopefully never pay out a claim. Homeowners insurance, same thing. They will check your credit before they will insure your home. Again, just to make sure that you are responsible and who you say you are. Your credit score should match. So the list continues to grow, how these companies use this information. So let's take a quick peek at credit scores across the United States. For 2019, I took a quick look. It's not much different. It's up a little bit over 704, which is the average FICO score in the US. And remember that not everybody is in the credit using system in the United States. But of those people who use credit cards or borrow money, take out loans, here's how it breaks down. 11% of the credit using population has a poor score, 579 or lower. 13% have a fair score, 17% have a good score, 19% very good, and 21% has exceptional or excellent. So the vast majority of people using credit, 40%, have exceptional / very good. I will tell you that the exceptional credit scores typically belong to older Americans. And why is that? Well, they've been at it longer, and your length of credit history carries a certain weight in your credit score. You're also more than likely to have a mix of types of credit. We're going to look at the composition of scores in a moment. So they have a more complex use of credit, and have been using credit longer, and this will raise their score. How can we see the impact of a credit score on the cost of credit? Well, it's in the interest rates reflected on this page. So for example, if you were to go into a bank and look to borrow $300,000 for a 30-year fixed rate mortgage, because you'll be buying an apartment, for example, if you just walked in without ever having checked your credit score to make sure that it was perfect and there was no erroneous information on your credit report, you might find yourself in the 620 to 639 bracket. So fair credit. If they give you the loan, they'll quote you an interest rate, 5.603%, and your monthly payment for the next 30 years will be $1,723. Now, if you checked your credit report before you even went shopping for this mortgage, and you took certain steps to clean up bad information, outdated information, and then some other tips I'm going to share for improving your credit score, and you got it into that excellent range, 760 to 850, you would get an interest rate much lower, 4.003%, and your monthly payment for every month for the next 30 years, $1,433. And in the bottom, you'll see the dollar difference in getting the good rate versus the bad rate, the higher interest rate. You could save more than $100,000 just by taking the time to improve your credit score. So it is very, very important. It is easiest to see this in a mortgage illustration. And obviously for a mortgage that's 30 years long, this is very impactful. But the same is true for credit cards. If you have a better credit score, you're going to get lower interest. So if you have to carry a balance, it will cost you less. Same thing your car insurance premium. Same thing your cell phone plan. It makes sense to know what your credit score is. And anytime you're going to sign any form of contract, make sure it's as good as you can make it so that you get the cheapest interest rate. So, how do you create or improve a credit history in order to obtain a good FICO score? Number one, it's based on behavior, not income. So the number one way to do this is to pay your bills on time. And whether this means you should automate bill pay, automatically transfer bill payments out of your bank account or put them on a credit card, maybe that even gives you reward points. But you have, like your cell phone bill is never late because it's on your Visa bill, on your Visa card. You pay your Visa card on time, everything's on time. And this will help you raise your FICO score. Correct mistakes on your credit report, even something that just looks odd. The fact of paying attention can make your credit score bump up a little. I had a client who had incorrect addresses list on her credit report, suggested she lived in a place she never lived. She corrected it and she saw her score go up a little. There are a lot of reports that contain outdated information. We're going to talk about how long things stay on your credit report. So if you have a negative account from, say, the great financial crisis when many of us did, that should have rolled off by now. And if it's still there, you can go online. All of the credit agencies now have a website where you can submit updates and corrections, and it's on them to check it and to correct it and mail you a new report. They've got 22 days, I believe, to make that happen. The other thing you can do, in addition to correcting mistakes, is to apply for a credit card and use it responsibly to build a good credit payment history. So you don't want any late fees. So if you do this, if you get a credit card and you use it for 4 months, this is a positive account added to the rest of your accounts on your credit report. And this is going to benefit you by improving your score over time. If you have student loans, very important that you stay on top of these. They've got to be paid on time. You don't need those to be late. And if you run into trouble, given the current financial uncertainty, Be proactive in either requesting a forbearance where you don't pay, interest will accrue, but you don't have an obligation to pay, so you stay current, or a loan consolidation if you have trouble keeping up. Understand that paying a collection agency is not going to remove an item from your credit report. You have to negotiate this with a collection agency and confirm the agreement in writing. Now, another tip that I will share that may be helpful, particularly since we're in such an unsettled economic time and people are struggling with furloughs and job losses, it's a little bit daunting. If you are concerned about having a low or thin credit history, one thing you can do, not listed here, is be added as an authorized user to a card held by someone with a high credit score. This may be a parent, this may be a significant other, this may be a sibling or a dear friend. When they add you to their card and you want to be added to the one with the longest history that they've had for a very long time, you don't necessarily have to be given the card, so you're not actually going to use it. But what happens is the credit history on that card gets appended to your record. So for example, if you're somebody, and this is a great tip for people who have college kids starting out in the real world, they're going to have a tough challenge this graduating season, but one thing you can do as a parent or grandparent is add them as an authorized user. You don't necessarily even have to tell them you've done this. Hold on to the card. If you've had a card for 10 years and you've got a good credit score, all of a sudden they have a 10-year record of paying that bill on time, and they start to inherit some of this beneficial credit score. Okay, so I hope that that will work for you. Another thing to be aware of, these are really difficult economic times, and there is a lot of uncertainty and concern in the face of layoffs and furloughs about keeping up with bills. If you haven't heard of it, New York State has a Department of Financial Services. It's kind of interesting. We have an insurance department, we have the SEC, and we have a New York State Department of Financial Services. They have oversight of any entity that sells insurance and runs a bank branch and issues loans. So if you go to their website, dfs.ny.gov, on their homepage, they have coronavirus updates for consumers and small businesses. Down the left-hand column, once you click on that, you will see that they are leaning on any bank in doing business in New York to work with their customers about deferring loan payments on credit cards, deferring minimums due, interest rates, late payments. Life insurance premiums, same thing. If a company is authorized to sell life insurance in New York State, they're being asked to postpone the due date for premiums. Health insurance, if you're getting New York State of Health through our exchange, there's an opportunity to skip your May payment and pay it in June, and all the information is up on the website. Similarly, with property and casualty, meaning your homeowner's insurance, there's been a strong request, really kind of an obligation if you're doing business in New York, to work with people and not damage their credit reports simply because they cannot pay their bills on time. ATM fees have been waived, withdrawal limits have been waived, private loans also have some oversight, and there are some benefits that you can read about there. And as you probably have already read or heard, mortgages, they're expecting your call if you need more time to pay your mortgage, and foreclosures have been postponed for the time being. But there's more detail, again, at this particular website. So I mentioned this before, that your credit score has sort of a few layers. So let's go through how they comprise or compose your credit score. The biggest piece of your score reflects your payment history. Do you have a long history of paying your bill on time? That's worth 35% of your score. Again, that's why older Americans tend to have higher scores. We've been at it longer. If you've been doing it for 30 years, that's a big number, worth 35% of your score. Amount owed. This is the tricky one that credit card companies don't necessarily want you to understand. Do you max out your credit limits? So there is something called the credit utilization ratio. We're going to get into it on the next slide. If you max your credit limits, even if you pay your bill in full on time, this is going to weigh on your credit score. And this, how you use your credit, how much of the credit you use, is worth 30% of your score. So it's pretty significant. Length of credit history, 15%. Applications for new credit. Now this has two components. If you're somebody, and this happens a lot, you apply for new credit cards when you walk into Macy's and they're going to offer you 15% if you apply for their card. Then you go up to Bloomingdale's and they make the same pitch and you apply for that card. If you do this a lot, you can lower your score. Now it's only a 10% penalty, but it hurts you in two ways. Number one, the applications for new credit, too much of them, that 10% becomes negative. The other thing that happens is now you have two new credit cards, one from Macy's, one from Bloomingdale's. They have a history of 0 months. This gets averaged with your existing cards and your length of credit history gets shorter. So now you have a more negative 15%. So you can hurt yourself if you're not thoughtful about when and how you add new credit cards. If you're not about to sign a new car lease, if you're not about to apply for a new mortgage, no big deal. But if you are going to do anything that is credit score dependent, you might want to think and time this carefully. Mix of credit, types of credit you have is worth 10% of your score. And it doesn't mean necessarily that credit cards are less good than mortgages, but if you are somebody who has both revolving credit, where with a credit card, the amount you owe changes every month, and installment loans, like a mortgage or a car loan where you pay the same amount, do the same time every month, having both gives you a more robust credit picture and is worth 10% of your score. So I hope that's helpful in understanding the mysteries of why you have the score you have. So I mentioned the amount owed ratio, the secret sauce, negative impact on your credit score. If you use more than 50% of your available credit limit, it weighs down your score. And the same way that I explained before, applying for multiple credit cards within a short period. Positive impact. If you're looking to improve your score because you're going to go house shopping or car shopping or get a new cell phone plan, use less than 30% of your available credit. If you do that for a few months, if you're going to do something as serious as sign a mortgage, you go cash only for 3 months and use no credit, come in there perfectly clean. The other way that you can play with this credit utilization ratio, rather than get new cards, you can ask for higher credit limits on your current card. And if you've been a client in good standing and you have income, you typically are going to get yes. Now, right now, things are a little bit more volatile. If you're working, you probably will have an okay time of it. They may not let you extend it as high as you would prefer, but over time they will, so you can ask again. Fair credit reporting laws. How much or how long does stuff stay on your credit report? The good news is these are not permanent records that we walk around with, you know, the mistakes we made as an 18-year-old. Information, good and bad, falls off your credit report. The national rules are the most information stays on the profile for 7 years from the date of last activity. If you see, if you go into bankruptcy, it's a little bit different. That information, which is court filings, that stays on your profile for 10 years from filing. In New York, we've got some good news. Paid collections or charge-off remain on the profile 5 years. So most information in New York, most negative information, is gone in 6 years. So if there was anything that happened that wasn't great back after the financial collapse, the Great Recession, it should no longer be on your credit report. And you can go online with each of the credit bureaus and request that it be removed. Same thing, satisfied judgments. If you were taken to court for non-payment of a debt after 5 years, that needs to go. Now, the good news is if you have positive information, that tends to stay on longer. For example, if you've paid off a mortgage, if you've paid off a student loan, if you've paid off a car loan, that typically kind of stays on there 7 to 10 years. But it does mean that eventually it does fall off, and all of that good work improving your credit profile, you kind of have to figure out how to rebuild that. Types of credit cards very quickly. We have credit cards where you can carry a balance at interest, and we have charge cards where they expect you to pay it in 30 days. They really hit you hard with an American Express Green Card, for example. If you try to carry a balance, there's a big charge and a high interest rate. Secured cards for people who lack either a job or a robust credit history. You can get a secured card, and basically what you do is put down a deposit, $50 to $200, and that will serve as your credit limit. And you go out and use that card judiciously to build your credit history, meaning you make a small purchase. So if you had a $200 limit, you'd go out and you'd spend $20. So you're using 10% of it. You're being very, very careful. You pay it in full on time, so you never pay interest. After 4 to 5 months, this will raise your credit score. Now, another tip that I learned from a credit counselor, many of us have a Netflix account. It costs $13 a month. You can go out and get a card, a no annual fee card, and put your Netflix account on that card. Then auto pay that out of your credit checking account, so it's never late. So now you're using a tiny little bit of your available credit limit. Because you're using under 30% of it, you do this after 4 months, this positive account is going to raise your credit score. Once a year, you have to go out and use that card on something else. Otherwise, the data becomes stale and it gets ignored and loses its impact on your credit score. But this is another good tip to know about how to play with your credit utilization ratio. So where to shop for a credit card? Obviously, the bank or credit union where you opened your checking account. It's easy for them to say yes, they know who you are. Or you can shop at bankrate.com, and it's great because they present all the information apples to apples, so you can figure out if you're looking at no annual fee cards, which one has the right features for you. Always understand what the late fee is and what the interest rate penalty is if the late fee is incurred. Credit card rules. This is a wonderful thing. After the financial collapse, it was discovered that many credit card issuers, especially some banks, were really treating their customers very poorly and making it very difficult for people to stay on top of what their interest rate was, and late payment warnings, and made it very hard to figure out, how long would it take if I just paid the minimum payment to get out of debt, and how much would it cost? Now on the front of every credit card statement, it's going to show you how long, or actually what you would have to pay off the debt in 3 years and how much interest you would be charged. So it helps you make decisions about how quickly you'll pay down balances. Pivoting now to debt. We're going to focus on credit card debt, but this is just a quick list of all the other types of debt that people take on. Okay. On your credit report, as I mentioned, it starts at the top after your biographical information with your loans in good standing. All your good accounts, whether these are credit cards, student loans, mortgages. Lower down the list are the accounts where maybe you forgot to send in a payment, or you had disputes, accounts that maybe you forgot about that went into default, got charged off, and ended up in collections. And after that, of course, any judgments and garnishments and all that good stuff. Just so you know, if you don't pay your taxes, you can be subject to wage garnishment without being taken to court, and that's both at the state and federal level. Same thing with federal student loans, child support, and unpaid court fines. So now we're going to pivot and we're going to talk about how to get rid of credit card debt. And I'm going to talk somewhat fast so that we can finish a little bit after 3 and get to some of your questions. So options for getting rid of credit card debt include doing it yourself, pulling up your socks, figuring it out, resolving to change some behaviors. Another option is debt consolidation, which I'll explain how that works. Another option is what's called debt settlement, and I'm going to explain why you probably don't want to do that. And then lastly, I'll explain how credit counseling and debt management plans work. Doing it yourself. First thing you're going to have to do is stop using your credit cards. So this means getting rid of the credit cards you've got set up for all of your online purchases. So Amazon, Grubhub, Apple Pay, all of that. You take that off of there so that it has to be done manually and you get out of that bad habit. You have to think about whether you're committed to this and whether making these changes is going to work. And lastly, what's very important is you're going to focus on one card at a time. One of the challenges I see with people who are trying to get out of debt is that they get a little bit of extra money and they send a little bit extra to each card, and you don't make any progress, then you get discouraged and you go back to spending and increasing the debt. So you're going to focus on one card at a time. So the question is, do you start with the smallest balance or the highest interest rate? So the answer is you want to target the highest interest rate first because that one costs you the most money. So what's the process? First, you're going to take a piece of paper and you're just going to go through all of your bills and write down the total amount owed, the interest rate, and if you don't see it, it's on the back of your credit card statement. Then you're going to list the minimum payment, and then you're going to rewrite the list. So just take it all down first, then get another piece of paper and write it down so the one with the highest interest rate is up at the top. Even if you don't owe them the most money, you want the highest interest rate at the top. Here's an example. So this is a picture of somebody who owes $6,000 to many different credit cards, but also a credit union loan, and it all adds up to $6,000. Variety of different interest rates. If you look at the finance rate, which is the third column over, you see MasterCard is charging 29.95%, and Macy's, this is fairly expensive. Then we've got our minimum payments, then we have the suggested monthly payment. Now, the most important number on this particular slide is the amount at the bottom, underlined, $650. And this represents the amount that this person has in their budget for monthly debt repayment. How do they know? They did a budget and they figured out this is what I can afford to spend every month to get out of this debt. So how do we do this? Well, first, you'll see over in the right-hand column, the $650 again. You're going to pay $51 to the credit union, $10 to Barnes & Noble, $35 to Visa, $55 to Amex, $20 to Home Depot, $15 to Macy's. So you're putting all of them on minimum monthly payments. The rest of the money, what's left from the $650 after you do that, is $464. That gets paid against the MasterCard bill of $1,500. You do this, and in 3 to 4 months, you will pay off the MasterCard bill. Then you roll it down, and your Macy's payment is gone in less than one payment. Roll it down to Home Depot, one payment, you eliminate that. Roll it down to Amex, and it starts to go faster and faster as your snowball gets bigger, right? This is what's called the avalanche method, where the dollar amount that you're applying to each successive debt gets larger and you pay it off faster. Because these debts down here have lower interest rates, this is costing you less money. So you want to get rid of your most expensive debt first. Now, a lot of people say, oh, but let me just pay off that Macy's, then I have fewer of these bills to worry about. Okay, we'll do that. Pay off Macy's and then start this process. That approach, where you knock out one particular debt and give yourself a pat on the back, is called the snowball method, popularized by Dave Ramsey, who's a personal finance advisor. So this is how it works. This mathematically saves you the most money. If you retire your most expensive debt first, it also is the fastest because you are eliminating the most expensive debt and rolling it down month by month going forward. So what's important? You absolutely need a budget to figure out what you can afford to spend to get rid of this debt. So you have to put that all down and think about whether or not you're committed to the financial goal and to stop using your credit cards. And what if you don't have available income to pay down debt? What other options do you have? If you're basically getting to the point where you're just covering your minimums, is there a way to get ahead? So yes, there are ways where people who don't have $650 but do have a fair amount of debt can get on top of it. So one thing you could look at is what's called debt consolidation. So if you've got good credit, if you have available income or savings. So what you could do, first off, look at taking out either what's called a personal or debt consolidation loan from your credit union. And I point people to the credit union because you're a member, not a customer, and members generally get better treatment. And credit unions tend to have lower rates. So what you would be doing there, so say you had $6,000 in debt, various credit cards and other obligations. If you were able to borrow $6,000 at 7%, that would be a good thing because you could then pay off all of those more expensive debts, then pay this maybe over 3 years or 5 years, pay it off at 7%, a reasonable monthly amount. And that would take a lot of pressure off your monthly finances. So that would be a good thing to look into. The other thing you could talk about or look at is doing a transfer, a balance transfer card to a 0% APR credit card. I will warn you, I've looked at these on bankrate.com. A lot of them have raised their credit score requirements to get the better cards. Now, these aren't free, but they are helpful. They're not free in that they charge a percentage of the balance you're transferring over, and that gets added to your balance. So when you eventually do pay this off, you have to pay that extra fee. But if you can move it from being charged 22 or 29% to 0% for 12 months or 15 months, you can chop away, and this monster is not getting bigger. The other good thing that would happen is after this initial transition, so you add a card and you move and you have this balance on it, in a couple of months' time, as you're paying this down at 0%, the fact that your original cards now have 0 balances will raise your score even higher. Lastly, another option for people who have a home, own their own apartment, is a line of credit or a home equity loan. These, of course, you are tapping the equity in your homes. You absolutely have to make sure that this is the right decision for you because it is a lien against your home. And if you get into trouble keeping up with your bills, you don't want to put your home at risk. Next thing, all of us right now could call up Visa and ask for a lower interest rate for carrying a balance or to have our fees waived. And as I mentioned here in New York, if you're calling Chase to ask for this on your Visa card, they've been told that they should do this. So you're going to get a quick yes. Now, if you really need more help than that, help for like a month or two, you can ask for what's called a hardship plan. And there, what you're asking for is to waive fees and interest rates, give you a payoff amount, and let them know that, you don't want to file for bankruptcy, but you're really in a tough spot, maybe because of reduced income or a furlough. If you negotiate this, you want to confirm the conversation with a letter. Never assume that a telephone conversation is recorded and available to you to show as proof. You want to send a letter and the payment and start your plan. Some of these are going to be temporary. Some of them will be long. They're never longer than 5 years, and your account is very likely to be frozen or closed. If you end up dealing with collection agencies, which can happen, stuff ends up, if you can't keep up with it, recognize that they pay pennies on the dollar for your debt, and you can negotiate with them. A lot of these companies, and I've had medical debts end up in collection. I had insurance end up in collection. There is a lot of great information on the New York City website, or if you call 311 on how to deal with collection agencies. They have to be registered in the state of New York in order to come after you. This is one of the areas where they will bend the rules, and people who are well outside New York and are not licensed to operate in New York will buy debt and try to get you to pay it. So the first thing you want to do if you are contacted by a collection agency, if you have any concern that this isn't yours, you don't recognize what they're talking about, have them substantiate your debt in writing. Ask them to provide proof that they own the debt, copies of statements from the original creditor, and a complete payment history. Now, why do we do that? Remember when I told you that credit card companies after the great financial crisis, and some of them sold off their credit card receivables. A lot of banks got out of the credit card business. It all got reorganized. Not all of the details and records were transferred properly. They may not own this debt. They may not be able to give copies of statements from the original creditor, etc. So if you send them this, and you're talking to somebody who's being paid a percentage, really a commission for hounding people to get them to commit to pay money, they will likely move on and bother somebody else. But if they do come back to you and they do respond in writing, explain what you can afford to pay. Don't assume that you have to pay the full amount. You can pay a single payment or set up a payment plan, but if you do either, make sure you are on time with the payment, and request that they list your debt as paid as agreed. If you don't send a letter requesting this, it's unlikely to happen because, again, the collection agencies don't care about your credit report. They're there to shake you down for money and move on. If you've confirmed by letter that they were going to do this and they don't do it, you look on your credit profile a couple months later and your paid off debt is not listed paid as agreed, you can have the credit bureau fix this because you have a letter that says that that was part of the agreement. You fax it into them and they will fix it on your credit report. Remember about the 6-year statute of limitations on consumer debt in New York. 6 years after the last payment you made on a particular debt, remaining debt can no longer be collected. So if you had any problems during the great financial recession, it shouldn't be still bothering you. If after 6 years you make a new payment, you start the clock. So you have to be very careful. And not just making the payment, don't say you're going to make a payment if you happen to be called by a collection agency. And you may ask, how can it happen that after all this time a collection agency would call you? Uncollected debt gets sold from one collection agency to the next, and they may take another run at you. So just recognize that that could happen and take no action. Now, debt settlement. Here is only, we're very close to the end here, a quick warning. This can really wreck your credit report. How it works, you've heard all of these debt settlement companies advertising on the radio. IRS bills got you down. We can help you make that go away. too much debt, we can settle it for pennies on the dollar. All of those promises that you hear aggressively hawked on news radio, they're generally debt settlement companies. And the way they work is you sign a contract agreeing to make monthly payments. They're going to deduct a fee and put the money into a trust account in your name. Your bills don't get paid until there's enough money for the company to negotiate a settlement, each creditor. If anybody has threatened to take you to court, that will proceed. Also, interest will continue to accrue, and late fees for not making payments are going to be added to your balances. All of this is going to show up on your credit report until it's settled. The debt settlement company is going to try to get your creditors to settle for 40 to 50% of the total balance. They're going to charge you 25% of the forgiven amount. Now think about that. If they're going to try to settle for 40 to 50% of the total balance, you're going to have to put money into the account for a long time till there's enough there for them to begin the negotiation. And what's happening as this is going on is that your credit report is looking uglier and uglier. Also, be aware that debt settlement isn't available for mortgage debt. Mortgage is a whole different process of foreclosure, and you have to go to HUD to get help with that. Unpaid tax debt, they don't really settle that. Student loan debt, federal student loan debt, no, that's not subject to any kind of debt settlement. And most secured loans like car loans, those assets simply are repossessed. So you have to ask first. Creditors aren't obligated to negotiate with a debt settlement company, and they can still take you to court. And then if you're able to be forgiven on debt of more than $600, you're going to get a 1099 at the end of the year and owe taxes on that amount, which seems like a bad joke. So you're going to risk serious harm to your credit rating if the accounts go into default status before they can be settled. The alternative that is legitimate, that is a reasonable process to pursue, is called debt management. And here you work with a reputable nonprofit agency that specializes in credit counseling and offers debt management services. And New York City has a list of these companies. If you call 311 and say, I need help with debt, looking for a credit counseling agency, they can direct you to a place on their website where they are all listed. You're going to get for free a counselor who helps with budgeting to figure out what can you afford to pay. You are going to pay the agency as part of this debt management plan, but you and your counselor are going to negotiate lower payments, reduced interest rates, and no fees while you're in this repayment period. So they can also assist with mortgage loans, get you set up with HUD, get you sorted out with your student loan servicer, any car loans, any tax liens. They are in the business of helping people get out of debt. And this is a regulated business, and the companies that work with New York City are screened and highly ethical. Thing to know about entering a debt management plan is that all of your accounts are closed to new charges. This is going to be a brand new you coming out of this process. The fact that you're receiving credit counseling is referenced on your credit report, but it's better than going through foreclosure or ending up in a worse spot. If you're being sued, it doesn't stop any pending legal action. But on the plus side, it does reduce your interest rates and fees, so it'll result in faster debt reduction. Collection calls usually stop, and you're making one payment to the agency, you're not juggling bills. The fee is set by the New York State banking regulators, and it's currently $50 a month. So we're at the end here. My recommendations: do not use a debt settlement company. If you're having problems with debt, or if you have friends who are having problems with debt, you can call 311 for a referral to their offices of financial empowerment. Green Path Financial Wellness is one of the city contracted organizations, as is the Financial Clinic and the Community Service Society Association. All are nonprofits. You can visit them, make an appointment for free, and they can help you figure out if a debt management plan is going to make sense for you. The New York Public Library is offering credit crisis counseling. They're doing it by telephone. So if you go onto their website and you Google or put into their search field credit crisis counseling, you'll get the telephone number and you can book a time to speak to a credit counselor. Practical tips and resources: request your credit profile once per year. Check for errors or any sign of identity thefts. Any accounts that you don't recognize, that's a problem. Notify the credit bureau immediately about inaccurate data. Internalize the credit use ratio up to 30%, never more than 50%, and only pay with credit cards which you can afford to pay off each month. Don't go into debt. Online resources, I've mentioned Bankrate. In addition, there's ftc.gov, Federal Trade Commission. Very good information without any product pitches. So it's an interesting place to read and get smart on various aspects of personal finance, especially credit and debt. Claro NYC, this is legal advice and resource, and they will help people who are being sued by debt collectors, and they've got education videos. New Economy, Know Your Rights, is somebody who owes or is in debt. They've got a great hotline and lots of information on their website. Office of Financial Empowerment, these are counselors throughout the 5 boroughs under contract with New York City to provide financial counseling, budgeting help, and debt help in particular. So well worth researching to see if you need an appointment in an office near you. I think they too are doing virtual, whether by Zoom or by telephone call right now. And that's that. I'll just scan through these, an appendix on identity theft. I'm not going to review it, but when Shana sends out the email, you'll have these. So here we go, identity theft, how to prevent it, what to do, and this very important identity theft website, which is new. Okay, so if you have any questions, I'd be happy to take them. I know I went a little bit over an hour here.
On the Q&A box.
Okay, pros and cons of freezing your credit. Great question. So mostly they're pros. When you freeze your credit, and I've had my credit frozen for about 10 years, I can be confident that no company that I am not doing business with right now can access my credit report. And that means that if some fraudster gets hold of your personal information, they can't open a new credit card in your name. It's frozen. The cons include if you have to be identified. So for example, I ran into this, I'm on the New York State of Health Plan, the exchange. When I first called up to find out how to get started, they used TransUnion to identify people. So I answered all the questions, but they couldn't see the answers. So they didn't know who I was, and I was forced to make an in-person appointment. Social Security does the same thing. Because again, if they're talking to you over the telephone, they have to make sure they're talking to the real you. So you have to remember that if you have a freeze in place, ask them, what agency do you use? What credit bureau? I need to lift my credit freeze so that you can view my information and we can do business. So that's the pros and cons. When there is debt, supposed medical debt, how do you clear this? Debt that is being charged, but providers were in network, copays were paid, and minimum requirements for insurance were met, but they still bill you. Now, one of the good things about medical debt, there's a recognition that there's unnecessary, there's a lot of stress around medical debt. It tends to be big and unexpected, and people end up going back and forth between their insurers and the hospitals or doctors that they owe money. So the good news is, I think this went into play about a year or so ago. It now takes 180 days of non-payment before a medical debt can show up on your credit report. That gives us a lot more time. That's 6 months to go back and forth between the providers and check what's being charged, etc. So you have some time before this becomes a credit score issue. And if you're getting the real runaround, there are services, medical bill adjusters that will help advocate for people. I don't work with one in particular, but I have a client who went down this route to deal with some really large out-of-state medical bills. And the good news was he got them to reduce these bills quite dramatically. Okay. What if your credit is okay and your spouse is bad credit and they are additional cardholders on your account? Well, what's happening with they're getting the benefit of your good credit, provided they don't have access to the card and make poor decisions using that card, meaning that the bill is still being paid on time, it's not being charged, you're not using too much of the limit, then you are okay. Okay. If that's not the case, if your spouse has a card and they're running up the bill and you're not able to pay it on time, you might need to have a tough conversation and separate your credit cards. It's always good, even as married people, to have joint cards and separate cards so that you can protect your credit score and keep it as good as possible. I hope that answers that question. How to handle a lien for a medical procedure that is pending a lawsuit regarding an accident that one is liable for. That might be slightly beyond my skill set here. That sounds more like a question for your attorney on what can be done to keep that from heading, appearing on your credit report. Okay. Sorry, I'm not able to answer that one. Okay.
Okay, so the appendix, so the option, we can add it on the e-newsletter, and also whoever wants the whole file, the PowerPoint that has the information, you can email me, I can email it back to you, but we're going to add the information on our e-newsletter that everybody can have access to it.
Perfect.
Okay. Again, thank you, Anthea, for great information. Like I said, I've been learning since last week. Then we'll see you again next week, Tuesday, the same time.
Yes.
And if you guys have any, if you have any additional question, please send it to me. I can forward it to Anthea. And we'll see you guys next week.
Yes. So next week, we're talking about the keys to successful investing, which will be an interesting topic given where the markets are.
Yes. So
thank you.
Thank you again, and have a great day, everyone.
Thank you. You too.
Bye-bye.